two ways of tracking the inventory flow, FIFO and LIFO. So there is a third one actually, weighted average cost, but I will just keep it to those two big ones. And I like to visualize it with an image. So FIFO, first in, first out, is it's a bit like a queue. The person that arrived first is the first in line. The queue starts growing, and when there is an item or a new spot that opens up, so the queue can be reduced, is the first one who came, so the oldest one in the queue that is gonna be taken. And LIFO is the other way around. It's more like a bucket, you see. So if you have a bucket with many stones, the last stone or piece of wood or whatever that you have on top is the first one to get out. And this is if you want LIFO. So you can see that if this is time 0 and this is time 1, after there is one operation with LIFO, you're stuck with, or you're left with the older inventory and the oldest, whereas with FIFO you have the most recent inventory. Now, consider the case of rising prices. On the LIFO, because you're selling the newest, most expensive inventory first, it means that the cost of goods sold will be higher, given that the prices are rising. Therefore, the profit will be lower, and the inventory on the balance sheet cheaper, right? Because it's made of the older one that was cheaper than the new inventory because prices are rising. FIFO, you're selling the oldest, the COGS is lower, the profit is higher, and the inventory is closer to the current replacement cost. And you can see how the choice between LIFO and FIFO impacts ratio, because the return on assets will differ since both the net income, as we said, and the inventory value have changed depending on the method that is chosen. So in order to compare companies in an apple-to-apple manner, the analysts will often need to adjust LIFO using what is called as LIFO reserve to approximate FIFO.